Today, I will be talking to you about a very rare opportunity that we have in front, and it's because of AI and the reality that now the hyperscalers and uh, those providing the picking shovels, the biggest beneficiaries of the AI revolution that's coming and that we are currently in, are being sold at a very big discount. The goal today is to present you information so you don't miss this opportunity. It's as simple as that. AI and the generational opportunity that we have in front right now. Let's see why. Current hyperscaler valuations, specifically Microsoft, but not only Microsoft, present a rare entry point for the AI super cycle. Microsoft right now is being sold slightly cheaper than 2026. 2020 we have to go to back to 20 to 2016 in order to find in order to be able to buy Microsoft at the forward PE of just 21. Right now it is at 20. So now it's cheaper. And what's interesting is that back in 2016, there wasn't an opportunity as big as AI is now. It was a time when Microsoft was starting to compete with Amazon Web Services, and it was a very interesting opportunity. They were transitioning also to the software as a service, and that made us pay for software through subscriptions instead of uh, paying for a CD or DVD or whatever. And that was interesting. That was a business model that Wall Street and the market loved because it was guarantee funds, right? Not only you didn't have to sell a copy every few years. You had people hooked, paying you every month, every year for subscriptions. But that opportunity was great, but it is not a tiny fraction of what AI currently represents. And what's interesting is that if you have bought Microsoft at 21 times earnings, your returns would be today, 10 years later, approximately 6x, 5.92x. You would have $6 for every dollar invested in Microsoft, and that's not including dividends. You compare that, that's 19.47, 45, something like that. If you compare that to the S&P 500, the S&P 500 basically gave you half that return, 13% and something, but compounding 13% in 10 years is exactly 3 point something x your money. So buying Microsoft at 21 times earnings is an enormous opportunity, something that comes along once every 10 or more years. And we're going to see a graph of the rest of the hyperscalers and Nvidia and its current forward PE. So you see that the market right now is in extreme fear, pricing those amazing companies in their best moment ever as if they were entering troubled times. The catalyst, why now is bigger? Well, what I said, the cloud transition of 2016 was interesting, but not remotely as close, as big as this one is. So basically, the AI opportunity eclipses the cloud transition. We're moving from selling compute to selling cognition to selling intelligence. See, so one data, one something that's worth knowing is what's happening with the two main competitors in this race, Anthropic especially. Anthropic, back in November of 2025, had a annual run rate, its revenue, where they were in about $7 billion. Right now, they said like a month ago that they were more likely to end this year with 77 to $90 billion. Just so you know, that would put them as the second company, the second pure software company in the world. And that's a company that 4 years ago didn't exist. That's the size of this. And they are compute constrained. They don't have capacity. They have their customers want to pay them more, but they don't have means, they don't have compute to sell them the tokens that they want to buy, the intelligence they want to buy. So that's why we know, and since there's only a few companies that has started trying things with these systems, we know that this is extremely early, as the hyperscalers have been telling us for the past 2 years, and so has Nvidia. So that's the point. What's an enabler to this situation? We are compute constrained. Beta Rubin systems have been shipping. They started shipping, and CoreWeave is installing them right now in some of their data centers. And Beta Rubin is going to increase by 10x with a click the amount of tokens that we're selling, that the hyperscalers and the AI labs are selling. And that's going to be unbelievable. We don't see that kind of jump in productivity in any field. And now the introduction of Vera Rubin, that's going to be available in the next few months, in the next few days, I would say. It's already shipping. It's going to provide 10 times the output of the LLMs for the same amount of electricity. And that's important. That's extremely important, because we are in many places electricity constrained. The compute constraint is actually a lack of electricity. So when you replace one system that you don't have electricity to power on, or that you have on, but you replace it with a Blackwell, the previous gen, with this next gen, you're going to have 10 times the amount of compute to sell. And that's going to be massive. That's going to provide compute, and that's going to make hyperscalers and AI labs, it's going to give them the capacity to sell a lot more, 10x more. We know that some of the cost advantages of the cost reductions are going to be passed to customers and other actors in the value chain, of course, but hyperscalers and AI labs are going to be able to sell more compute, to sell more tokens. Tokens is, remember, the output of intelligence of these LLMs. It's a PowerPoint presentation that they do for you, an email that they do for you, some software that they do for you. So with that inclusion, what's coming in the next few weeks, days, is extremely interesting, because the cost of intelligence is going down dramatically. And with what we have seen so far is that a reduction of the cost of intelligence, what achieves is an increase, even not even proportional, but exponential in demand. With this kind of improvements, also the intelligence of the system improves, and with that we have more use cases, and more use cases for cheaper, for less money. That's what we have been seeing in the past three years, and that's what's going to happen now with the inclusion of the Beta Rubin systems by Nvidia, and it's going to be a very interesting moment when we combine this with what we saw with last week with the earnings report of Alphabet from the second quarter of 2026 that we made a video, and we're going to link it in the description. When we combine 83% growth with these capacity additions, we have reasons to be excited and to know that what's coming is awesome. And I want to answer something to the bears. This is an answer. This is specifically for the bears, because yeah, there are scenarios in which all this doesn't go right, doesn't go well. Of course there are, but the bears and the whole market, because the whole market is super bearish. And that's why we have the valuations that we are about to see, we are going to see compared to the history. What they keep saying is that Anthropic, the second company of software in the world, founded just 3-4 years ago, they say there's no path to profitability. They think that because they are burning cash now by building these immense data centers and by paying a premium for the compute they don't have, that's right, that's the reality. They say that their business model is non-existent, that they won't be able to make any money because they already are selling 30, 40, 50 billion, whatever, and they're still not profitable. That's so short-sighted. And it's like coming from somebody's claim that it has to be somebody who hasn't been around for very long and hasn't been doing their homework as investors, because that's the reality of mostly every single tech company in the world, every one of them. And I want to show you Uber, the president of Uber. It was founded in 2009, and as you know, Uber is software basically. Uber don't buy cars. Uber is as asset light as it is possible, even when the actual business is, the actual value for the customers, or an essential part of the value is provided by cars, which would make the business asset heavy, right? But their innovations and everything, we know Uber. In even being an asset light company as it is, it took them 14 years to achieve profitability. To have a quarter with operating profit, it took them 14 years. And now bears are concerned and saying there's no path to profitability in the AI business and in the models and the model makers, the frontier model makers, OpenAI and Anthropic, because they've been without profit for 3 years. That's extremely short-sighted. And honestly, I think it's just a rationalization of fear. It's true that everything is changing so fast, and the amounts of money that the hyperscalers are investing are simply hard to grasp. It's you have 4 companies, 5 companies in the world investing close to $1 trillion. That's unheard of. That's so much money, but that's the size of the business. And we're gonna be seeing a video by nobody else than the GOAT himself, talking to us directly about the situation that we're in now, in which we need to invest money to make money, and how this is what we as investors should be seeking. Businesses that make $20 million a year and can invest those 20 millions a year to keep compounding and making money. But not only that, that they that the case in which they need even 100 additional uh, 100 million additional to invest, that's what we want, and that's the kind of business we have now in front. The downpipe risk, that's another bearish take, and it's I think it's more reasonable than the first one, and it's that, well, the hyperscalers are providing the infrastructure, and in the past, those who use the infrastructure were the ones benefiting uh, from those investments. Yes, that's right. That was the case with the providers of connectivity, AT&T and T and Verizon. They did well, but not so good. We know that Google, the Amazons of the world, the Metas, they were the ones making the money on top of the infrastructure that Verizon and AT&T and the rest built. That's right. The difference now is that AI is software. And as such, if AI is going to have an impact, it's going to start impacting the kings of software, the tech industry. And that's what we're seeing. Software, with the growth of AI, what we're seeing is that software is going to take the world. Software is going to be doing things that we weren't able to introduce software before. It's going to add value and create value in places that we simply couldn't before because we didn't have the tech. Who is going to be better at software than, let's say, Microsoft? Who is going to be better in software and at software development and doing things with software than Meta? I just, that one, it could be, that's right. In fact, we have two labs in the frontier and now out there coming from China. And yes, they're not. They're not Microsoft, they're not Google, they're not Meta. But there's something interesting. Google is right behind Frontier, and not only that, they are the second or third. They are shareholders in Anthropic, who's the leader. They have almost a sixth of the business, maybe slightly more, and Amazon owns a fourth of Anthropic. And even Microsoft recently invested $5 billion that gave them about close to 2% of Anthropic. And on the other side, OpenAI is owned by Microsoft. I mean, Microsoft owns about 27% of OpenAI. So they are the ones pushing this uh, technology because they're the only ones with the deep pockets, and they were the pioneers who saw the technology first, who pushed it to the point it is now. They were the ones backing whatever lab, whatever company that was an enabler of this technology, and as such, they're the ones using the technology. Jensen Huang from Nvidia has said that a big part of their edge as chip and systems designers has a lot to do with the fact that they have 4,000 software engineers and they were all using AI to design systems. So I've made a video previously in a presentation talking about the K-shaped economy and how AI, what does is increasing your productivity, but it basically assigns a power to whatever baseline you have. And what that means is that if I am more productive than a third person, we're both going to be increased, but my increase is going to be a lot bigger. So we're gonna be more separated. Even when the person who's less productive than me is way more productive, what we're going to be seeing is that the difference, the gap between us in our productivity is going to be bigger. And based on that premise, and it is a premise, what we have is that those top companies are going to be massive, massive beneficiaries uh, of these technologies, and we are already seeing it. Just check the previous video. I'm going to link it, so you'll see what's happening to Google Cloud and other numbers. Or also, you can check the earnings report of Meta for the first quarter of 2026, so you can see the huge impact that using AI is having and how they are accelerating growth, accelerating margins. It's very interesting, and then it's mostly AI. So it's a possibility that they build the technology and they build the infrastructure that enables the technology, and they end up being disrupted. It's a possibility, but based on all that I said, all that I told you, I think it's a tiny possibility. Okay, now we will see the goat. Let's listen to this because it's so relevant to what we're living today.
The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. That becomes a compounding machine. So if you could put $100 million into a business that earns 20% on that capital, say 20 million, ideally it would be able to earn 20% on 120 million the following year and 144 million the following year, and so on. You could keep redeploying capital at these same returns over time. But there are very, very, very few businesses like that. Unfortunately, the good businesses, take a Coca-Cola or See's Candy, they don't require much capital. And incremental capital doesn't produce anything like the returns that this fundamental return that's produced by some great intangible. So we would love the business that could keep deploying, in fact, even well beyond the earnings. I mean, we'd love to have a business that could earn 20% on 100 million now, and if we put $1 billion more in it, it would earn 20% more on that billion. But like I say, those businesses are so rare. There are a lot of promises to those businesses, but we've practically never seen one. There have been a few. The ideal business.
There you go. They are so rare. From the Oracle, Warren himself. Those businesses that print cash, they make 125 billion a year, but they need 250, so they go out to get credit or dilute or sell equity because they need so much money. And you saw the print. They need money in order to sell compute, to sell services that are netting 35.6%. And you will see tomorrow that Microsoft has its earnings, it presents earnings tomorrow, July 30th, Wednesday. What you will see is that margin, it's probably around that, and they are also investing almost $200 billion dollars in 2026, in calendar 2026, and they're very likely to increase that amount for the next year because of the commitments and the demand that they have now for the service. Warren is telling you that the reason that why Wall Street and the market is selling and right now giving you the opportunity to buy these businesses at a very low valuations that you can see once every 10 or 15 years, is because of what Warren is seeking and what we all as investors should be seeking. What company wants money because they're going to be making so much money. Tomorrow we will have the earnings report from Amazon and from Microsoft. And the important issue, the the point that I will be focusing my attention is not in the rest of the business. I am looking for the data of Amazon Web Services and Microsoft Azure, and I'm gonna be putting more money to work in whatever of those companies who say that they will keep and raising their investments for the next year, just as I said in the video I made about the earnings of Alphabet. And that's what they did. They said that they were going to increase significantly their capital expenditures for next year. That's what I want to keep seeing because I know the kind of business they are building right now. So that's what I wanted to show you. And now I want to show you this graph. This graph right here is the forward PE of these companies. Look at that. Let's see right here. I want to see Microsoft. Oh, I wanted to show you Walmart and Costco so you can compare how Costco, an amazing business, awesome business. Look at that, 44 times forward earnings, and that's at the same time that the market is paying only $20 for $21 for a dollar of earnings for Microsoft. So basically Costco is being priced at twice Microsoft. That doesn't make any sense. It doesn't make any sense. And this will be historic. We'll be talking about this in a not so distant future because this is an anomaly. And as I said, what I want to make sure is that you don't miss it. That's all. That's all I want. That you don't miss this opportunity because we don't get this kind of opportunities often. The same with Amazon that we have here. Amazon, it's the blue one. Look how the forward PE of Amazon had never been this low. It was lower when Amazon was at below 25 times forward earnings a few months ago. That was an amazing entry point, but we're still so low. And there's something important that I always keep saying. The only one who's been spot on talking about what's coming in the past 3 years has been Jensen Huang. Everybody else, every single analyst, has been way below what ends up happening. So these valuations are even lower. It's a fact. They are even lower than that because those expectations are way lower than what's going to be end up happening. But let's say that this is consensus, so let's assume that's the reality. Microsoft, you had to go, as I said, to 2016 in order to find Microsoft at valuation similar to this. And that doesn't make any sense. Here we have the numbers of Google. Google, as you can see, is fairly valued, sort of. I think when we consider everything that's coming and everything they have been doing so well, I understand it's a great opportunity to buy Google. The fair price is amazing, and that's why Warren himself and Berkshire Hathaway started that position, and they bought equity at a price that's higher than current price. They bought at $352, and the stock right now is at 330 something. So that's, you have the opportunity to buy cheaper than what Warren and Berkshire Hathaway bought. That's always for 70 years it has been great to buy at the prices that that he bought. I doubt that we are in an anomaly in which uh, that's going to be different. It is not. It is not. So that's the thing. I'm going to. I wanted to share all this with you, and the goal, as I said, is simple. Do not miss. Do not miss this opportunity because it's immense. Tomorrow or today, the video is going to be published on Wednesday. We have hyperscalers reporting, and as I said, I'm going to be putting my money to work, more of my money to work, in those embracing and those saying that they're going all in after uh, the opportunity of AI and building the infrastructure to make the rest of the world depend and depend to them, in them, as the enablers and the owners of the infrastructure that makes uh, AI possible for the rest of the world. I'm gonna be observing that, and I'm gonna be overweight whoever goes hard and shows result, of course, and I'm gonna be underweight or cutting or even selling 100%, and those who simply decide to cut CapEx, which is extremely unlikely to happen. But that's my take. As I always say, remember, this is not financial advice. I'm just sharing my analysis with you. My experience. This is more education, and in hopes that it's useful for you. You have to make your own due diligence and make your analysis before investing money and putting it at risk. So I hope that this serves you well. If it did, uh, subscribe to keep receiving more content. And a like to the video always helps. I will see you in a next one.